How closely, if at all, are you watching the Fed and what it says?
Well, we are watching the Fed a lot. This has been a Fed rally since 2008. We've said Jerome Powell is the most powerful man in the markets that we look at. Jerome Powerful is what I call him, because what he says, thinks, and does will drive this market more than anything, more than that little retail number we saw yesterday, which I think was a bit of an overreaction. It's going to be all about what the Fed says out of Jackson Hole, how measured they are, how calming they are to the market, saying, hey, we're just going to take a little bit off the table over a prolonged period of time. Let's not panic. And I think investors are getting that message. So I think the Fed is going to begin to taper. They're setting the table for it. They are the biggest driver in this market. There are other factors, but when you look at the root of how they rebounded us from the depths of 2008 and the spring of last year, you can't deny the Fed is the number one factor facing investors.
All right, what would be number two then, Mark?
Well, there's a confluence of other factors that also matter. You have congressional spending, which is massive. You had super strong corporate earnings, and you had good guidance. And you also have trillions of dollars on the sidelines. You take those three factors and this accommodative Fed, and that's why I want to look beyond yesterday's number. I think it's a bit of an overreaction. I'm reading this morning that we had a plunge yesterday. We had a plunge of less than 1% after a rally that's phenomenal. We had two historic years. Last year and this year, the markets are up. We've doubled off the lows, and a less than 1% plunge. That doesn't resonate for me and my investors. So I think those four huge factors will dominate these little headlines. That said, it shows me that investors are jittery. And what worries me most is there may be hot money in the market. And when we get a little blip with a little news and we get some algorithmic trading, that could send stocks down. And that's what concerns me more, not the underlying pinnings of this market.
Yeah, but a lot of people maybe hoping for a pullback, Mark. As we've noted, we haven't had a 5% down move for the S&P in 10 months. I mean, that is truly, truly remarkable. Knowing then all you know and all you've just said, what are you advising your clients to do?
Well, that is exactly why I'm bullish, because with all these people waiting for 3, 4, 5%, with up to $4 trillion on the sidelines, it's a supply and demand function. There's going to be a demand for stocks. The demand for a product increases its price. So this is actually a bullish sign. And I actually hope we get a modest correction, because we will see some of the shakeout of the higher multiple, lower quality names. We'll get a return to more fundamental investing. Bull markets are characterized with mini corrections, and even a 10% correction, which I don't think we'd go that low. Even 10% corrections are not uncommon, and I think a mini correction here could be looked at as a bullish signal.
And so what are you buying with that? If you're bullish longer term, is there anything that looks even fairly valued right now, Mark?
Well, if I believe in that strong economy and a modest Fed response, I'm still going to love technology. I think it's going to work whether with its Delta variant gets a little more widespread. And I think it's going to work if the economy just looks beyond that and grows. I think stocks like Amazon, which have not really participated for the past year, are going to be looking good on a valuation basis. We've seen the other FANG names do very well, Alphabet and Facebook this year, Apple as well. We still like tech. We think financials across the board, whether it's the traditional money center banks with capital markets activity, asset management, great loan credit quality, they're going to look good. Regionals and even community banks on takeovers and mergers to compete with the aforementioned larger players, as well as fintech and online deposit gathering machines. So we like financials and we like technology.